My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Special Summer on the Street edition of Mad Money. Welcome to Cramerica, coming at you from the New York Stock Exchange to help make sense of this week's wild moves. Hey, listen, other people want to make friends. I just want to try to make you some money. All right, well, I do have a few friends here today. My job, not just to entertain, but to teach, educate. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, we know this market has turned into a roller coaster. Dow rebounding 312 points today. S&P climbing 1.30%. Nasdaq gaining 1.39% after yesterday's unbelievably terrible session. The reason? Because we don't know if we're in a trade war or a Cold War. Does the Trump administration want to strong-arm China into buying more American-made products? Or are they trying to destabilize the ruling Chinese Communist Party? We don't know. Are we negotiating with the PRC? Or is this more like when James Bond asks, do you expect me to talk? And Goldfinger responds, no, Mr. Bond, I expect you to die. The free traders in the White House expect China to talk. The president's top economic advisor, Larry Kudlow, came out this morning, squawk on the street, and predicted that there could be productive talks in September after the new 10% tariffs go into effect. Oh, but the hardliners, on the other hand, they want China to fundamentally restructure its whole economy so they stop stealing American intellectual property and truly open their markets to foreign competition. The free traders act like it's all about commerce. The hardliners make you feel like we're in a brand new Cold War. In reality, you know what? One of the reasons I guess I don't want to say I'm sanguine, but I'm okay, is that I think there's a middle ground. But to get there, the Chinese government needs to make some major concessions that they've been unwilling to do. At the moment, China just doesn't want to go there. Eventually, though, I think they might have to. That's why I am more sanguine about the trade war than most of the talking heads you hear from every day. Why? Because communist China has spent the last 40 years embracing capitalism in their own way. In the old days, everything was state-owned. Now half of Chinese industry is in private hands. And these companies are actually hurting. There's a major slowdown in capital equipment spending in China as they feel the pain of jobs migrating to other countries to avoid the tariffs. Hey, make no mistake about it, okay? These tariffs are indeed a nightmare for the People's Republic. They're working. Any U.S. companies that can relocate are relocating to ABC, anywhere but China. In a way, the Communist Party is a victim of its own success. They've done such a great job of creating an export-driven economy that they're now hostage to their trading partners. Think about that. They're now hostage to their trading partners. The PRC exported $539 billion worth of goods to the U.S. last year. Hey, come on, that's a giant chunk of business. You know what? China has a lot to lose. America, though? We've been hemorrhaging manufacturing jobs for decades. There's not much China can do to us that they haven't done already. The United States simply isn't an export-oriented economy, which is why we only sell $120 billion worth of goods to them. That's not even 1% of our GDP. We've got a strong job market, incredibly low inflation, plentiful natural resources. China faces a mass exodus of jobs thanks to the tariffs, and their economy was already fragile. They are resource-deprived. At the end of the day, we don't need to make a deal. However, I think that's actually a bad and unnecessary outcome. It would be destructive for all sorts of industrials and technology companies that you and I like that do business in China. But when all is said and done, it's still not going to wreck our whole economy. We are not going into recession, people. We're not, because of the tariffs. We're not going to do that. We have too much steam to fold. So if that's the case, where did yesterday's hideous decline come from then? There were three major causes. First, the obvious. China let its currency fall versus the dollar, and the Treasury Department labeled them a currency manipulator. China used to be really egregious about pushing its currency lower to boost exports, but for the past decade, well, they've been doing the opposite. In response to the latest tariffs, they showed us that they're still perfectly capable of devaluing their money when they need to. It was a real shock. Many hedge funds are already up huge, and when they saw this kind of craziness, they rang the register. Who can blame them? Second, Treasury yields have plummeted. A week ago, the 10-year was at 2%. Now it's at 1.71%. Historically, that's what you see when we're headed into a recession. As I told you, we're not going to have one. So when money managers see it, though, they don't consider the context, which is that the rest of the world has much lower rates than we do. They just assure we have a crumbling economy. They just assume it. It's like, hey, it's got to be. We wouldn't have rates that low. But the German 10-year is a negative yield, for heaven's sake. This is what happens when lots of money flows to the U.S. from overseas. Rich foreigners and government, well, actually, companies, trusts, they buy treasuries, which sends prices up and pushes yields down. Do not get me wrong. It's not good. It creates a strong dollar, hurts American exporters. But it's not necessarily a sign that we're headed for a recession, and it does make mortgage money cheaper. Third cause, U.S. companies with big overseas exposure are about to take a big earnings hit, or at least people feel that way. That's what they're selling. That's why they're selling Apple. They're selling Nike. They're the victims of the trade war. Somebody needs to eat the cost of these tariffs. That means many companies could be looking at slower earnings growth. That's a huge fear. However, it is also true that Watch, which is my acronym for Walmart, Amazon, Target, Costco, and Home Depot, haven't had to raise prices much to deal with these tariffs. They have, but not a lot. This next round may hurt them a little bit. But in fact, these companies are generating some of the best sales they've ever had. And that is emphasis on ever. Overall, it is a definitively mixed picture, which is why the Federal Reserve can't be more aggressive about cutting interest rates to bolster the parts of the economy that are weakening, even as I think the Fed should, because there's no inflation and we are disadvantaged versus almost every country in the world. I am sure they're still worried that there's too much momentum to cut again. I think they should rethink. Now, if we had a better sense of how the trade war will play out, it could be easier to get a read on the market. For now, we keep coming back to the commerce versus containment dilemma. If the White House is willing to settle for a commercial deal, meaning the Chinese buy more American crops and airplanes without restructuring their economy, then our stock market will soar. But if we don't get a deal, I think we get more of the same. More of the same like yesterday. And until the past week, the same was pretty darn good. Meanwhile, lower interest rates make dividend stocks a lot more attractive than consumer product stocks. And that is one reason, for instance, why Emerson, which is a big industrial company with major China exposure, could have put really a not-so-hot quarter this morning, yet stock did well. Although the main reason is that it was already down dramatically going into the print, and it was better than feared, BTF. That was also why Apple began rebounding today. And don't get me started on FANG. Neither Amazon nor Alphabet nor Facebook have much China exposure. Microsoft wouldn't be impacted. China's not important to the new growth engine, Azure, which is their amazing cloud platform. Okay, now let's put it all together. I think we're in much better shape in this trade war than the conventional wisdom would have you believe, and certainly the talking heads. And even if it drags on, there are plenty of companies that will do just fine. So why aren't I telling you to buy aggressively? Look, we just had a brutal rough patch that knocked off about 5% of the S&P 500. That's down 5% from the peak for the S&P 500. But we're still up big for the year. Dow, 11% gain for the year. S&P, up nearly 15. NASDAQ, up 18. Those are huge gains. While today's bounce was a good one, and companies actually managed to rally when they reported good numbers, witness Zoetis, Take-Two, Shake Shack, much of the session, the market looked like it was going to roll over until about 1 or 2 o'clock. But it wouldn't roll over, and that's bullish. The bottom line, those three prongs of panic that crushed us yesterday, currency, yields, and earnings, still have not been resolved despite the nice bounce today. I think we got more wood to chop before we can have a sustainable rally. But if you start buying stocks of high-quality companies where they're already down 10 to 20% from their highs, I think you'll be rewarded. It's simply not as bad out there as many people would have you believe. Yes, sir.
Hey, Jim. So I've been seeing the market and the general public just get really, really bullish on Snapchat. They see it as, one of the big tech companies, one of the ones that's going to be growing in the future, and I personally don't really buy it. What do you really see as the long-term growth and potential for Snapchat in their near and far and long-term future?
Look, it's a great question because Snap turned out to be better than we thought. There was an exodus of people at the top. People started worrying that Snapchat was falling apart. They have these big costs. But I would tell you that it is a stock that has run big from the bottom. I share your trepidation. I like Facebook much more, and I like Twitter much more. I think you're going to be right. Thank you. Yes.
Hi, I'm Ya from Mendocino, California, and I was wondering, with the uncertainty in the cannabis industry, do you think a company like Scotts Miracle-Gro is the way to go?
Well, look, I do believe that I thought that Afria did a great job this week. Erwin Simon used to run Hain. I like Kronos. Did they pay too much for some acquisitions? Maybe. My favorite is still Canopy, but frankly, we need to see a better quarter from Canopy than we've seen. Other than it's Afria, that's going to be the one I like because they reported really good EBITDA. Thank you. Yes.
Hey, Jim. Booyah.
Booyah.
Listen, I got a baby on the way, and I'm looking for a play for the long term. Between Intel and AMD, tell me who would you prefer?
Oh, I'm going to buy. Lisa Su has done a remarkable job. She's a big speech tomorrow on the server market. She is incredible. She turned around AMD. She has Intel on the run. I think she may be the most remarkable CEO of our era. I say go with Lisa Su. Go with AMD.
Thanks, Jim.
Thank you. And best of luck to you.
Thank you.
All right, the three prongs of panic, currency, yields, earnings, they have not yet been resolved. But I still hold that things aren't as bad as some are making them out to be. Buyers of stocks that are down significantly from their highs, that's what I want. I think you'll be rewarded. On Mad Tonight, what can we learn from yesterday's sell-off? I'm going through the most egregious errors I saw sellers make to be sure that you don't fall prey to the same pitfalls. Then Etsy fell more than 10% after reporting earnings last week. But could this be a crafty buying opportunity? I'm going to go to the CEO and the man, the myth, the legend. A-Rod joins me here on the street, along with the CEO of Barstool Sports, to talk the future of media. Stay with Cramer. Thank you.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.